Good evening, sir.
Good evening.
The Center for Financial Markets, IIT Ghaziabad, and Finance, the official finance club of IIT Ghaziabad, welcomes you for this interview. Today, it is our honor to have you with us. And, sir, so Joydeep sir has worked in this financial service industry for 25 years till 2016. Of this, the last 13 years were with BNP Paribas in the wealth management department as a senior vice president advisory desk. Prior to BNP, he worked with various companies in the private sector. Since 2017, he is on his own pursuing his passion. Sir writes columns regularly in various financial publications. Since January 2017 till date, he has published 539 articles in publications like Mint, Money Control, Economic Times, the Hindu Business Lines, and many more. Sir has authored multiple finance books, and his expertise has been recognized through numerous awards in the BFSI industry. The recent one being the most admired BFSI professional in February 2024. Today in this interview, we look forward to Sir's insight on a range of financial topics. So, sir, firstly, we would like to talk about the SEBI's recently published discussion paper proposed on the asset class, which is positioned somewhere between a mutual fund and a PMS. This proposal received a mixed reaction from the market. Do you think this can be a game changer for the industry, or there is something that the market is missing on?
So firstly, thank you for the wonderful introduction.
Thank you, sir.
Now coming to your question, so I would say it is somewhere in between. In that sense, it is neither a game changer nor that the market is missing something. So let's get the perspective. In the market, there are product manufacturers like mutual funds, PMS, AIF, and other manufacturers. They innovate, they ideate, and they come up with products within the framework. Now, as a regulator, also SEBI also does kind of innovation. So what we are discussing is that thing only, that as a regulator, SEBI also is innovating on regulations, as in they are allowing or they have proposed to allow a new asset class. Now, as you rightly said, what is this new asset class? Somewhere between PMS and mutual fund. Now, what is the meaning of somewhere between mutual fund and PMS? Let's say ticket size. Mutual fund, very low ticket size, like retail people can participate. SIP is like 2,500 rupees on an average. PMS, 50 lakh rupees minimum ticket size. Here it is 10 lakh rupees. Or for example, the exposure per issuer, per equity stock or bond per issuer. Mutual fund is 10%, PMS is 30%, this is 20%. Or for example, bonds. In mutual fund, it is graded, AAA, AA, single A, 10%, 8%, 6%. Here it is 20 and 8, 16 and all that. So basically, it's a doubling of that. Mutual fund, you're allowed so much. This asset class, proposed new asset class, you're allowed so much. So it is somewhere between mutual fund and PMS. So what is the rationale for SEBI to do this? There is a growing class, what we call mass affluent. So on one hand, we have HNIs, ultra HNIs, who can buy PMS, AIF ticket size of 50 lakh, 1 crore or higher. By the way, there are AIFs ticket size of 10 crores also. Now there is a growing mass affluent segment who are beyond mutual fund. They can buy mutual funds also. They are kind of beyond mutual funds, but 50 lakh may be a bit expensive for them. For those kind of people, this asset class has been proposed. So this will enhance the playing ground where manufacturers can play. So like earlier we had mutual fund houses who have now launched PMS, now launched AIF. And we also have specialist people who have floated only mutual funds or only PMS or only AIF. So we will have both kinds of players. We will have mutual fund PMS houses launching this product, and we will also have specialist houses who are running this product only. So net, I am positive about it in the sense it will add one more investment vehicles, so adding to the choice of the investing public.
Thank you so much, sir, for that. Sir, so since we're talking about SEBI, I would like to know how you see the SEBI's stated concern over the excess participation in the F&O market, and also how do you see the regulations in F&O developments in the future?
So that is a very valid concern. Why so? One may argue that any market should be left on its own in the sense the participants in the market, they should decide. But something is happening here. So if you look at the multiple in the sense the cash or spot market volume and the volume in the F&O segment, in India it is many times higher. So what I mean to say, let us say markets, including advanced markets, if cash market volume is like here, and F&O volume is like here. In India, cash market volume is here, and F&O volume is like here, many times higher. So somewhere there is a cost for constant, that is one. Secondly, when you look at the composition of participation in this segment, in the F&O segment, it is one thing to have institutional participants, it is another thing to have retail, and it's another thing to have retail people losing money. So you'd be aware, about 2 years ago, SEBI did this research. SEBI said that 90% of retail investors who invest in this market suffer losses. So 9 out of 10 retail investors in the F&O segment, they lose money. Not only that, even though few people who make money, they spend a percentage of that, of their profits on expenses. Expense as in, they have to pay brokerage and other charges, the money goes there. So net what is happening? Retail people are losing money. And SEBI as a regulator cannot really sit quiet on that. So nowadays, not even now, earlier, SEBI has passed a regulation that somebody trading on the screen, when the screen opens, the screen has to pop up with 50% area. That 9 out of 10 people, retail people I mean, trading in equity F&O, they lose money. That is one. The other area is, okay, SEBI may or may not say it in so many words, but I can say this thing. This growing phenomenon of so-called finfluencers. So what do finfluencers sell? Finfluencers sell dreams. They sell a dream that you do a 2-week course, you spend only 500 rupees, and you'll become a crorepati. Life is easy. Why work so hard? Why do MBA at PGT at IMT and work hard to earn money? You simply do spend 500 rupees only instead of lakhs of rupees in the course, 2-week course, and you become crorepati. Now you relate the two. People buying that dream, doing a 2-week course and becoming a crorepati, they're coming to this market and they're losing money. And another concern voiced by not even SEBI, even higher, the Ministry of Finance, the Finance Ministry, is that is the transfer of wealth happening from retail people? Like it is one thing for retail to save and invest in, it could be a bank FD, it could be equity stocks, it could be equity mutual fund, whatever. Is the money going to equity F&O? And in this process, where retail people, they are losing money. Actually, how the market works, one's loss, another's gain. So when one person is losing money, namely the retail, who is gaining? Another savvy market participant. Now who could be those? It could be institutions, either foreign or domestic, or it could be in a way even savvy individual. As an example, somebody is a broker, generational broker. He knows the market. He's playing the market for 20 years. He may be an individual, but he knows the market. So those people, those institutions or savvy individuals, they are making money at the cost of these retail people who have purchased that dream. So now what is happening? So as you said, what can happen? Okay, I don't have the exact answer, but broadly I can tell you. One is the futures we have monthly expiry. So options we have weekly, that may become less frequent, like monthly or whatever. The size of option contracts, that may be higher, so that it is little more expensive for people to participate, or maybe some other means which SEBI may adopt to discourage people or tell people what is what and discourage people from participating. Another thing which is proposed by SEBI but practically difficult to implement. For any manufacturer, as in product manufacturer, they have to have those eligibility. Like you have to pass an ISM 5A, an ISM 10A, ISM 21 and so on. For investors, there is no such requirement. There is one thing which has been launched by SEBI, which is free of cost by the way, investors can pass that, but it is only optional. Another thing is being kind of discussed and debated within SEBI that for retail participants in the F&O segment, they may launch a test and they may make it compulsory. Now if that happens, that will be this thing like filter, that even though you have done a course from a person who is charging you only 500 rupees and he or she has made your master in 2 weeks only, but people say it takes 20 years to understand the market. Are you really aware? But it is difficult to implement because once they say it is compulsory, there will be so many people who will stand up. No, this, that, democracy and that kind of thing. So some changes will happen, maybe the terms of those contracts, options and all those things, or some other thing which we don't know as of now, but yes, something should come on this front.
That was really helpful, sir. Coming to the last question, I would like to highlight the major changes in our fixed income landscape on the inclusion of Indian bonds in the Bloomberg and the JP Morgan bonds index. Could you throw some light on how you see these steps impacting the flows in India and what more should the market be looking for?
Okay, so at one step ahead, So that is about the sovereign credit rating. The sovereign credit rating of India is triple B minus, which is just investment grade, which means one notch downgrade, we are junk. And why are we so poor? Fundamentally, we are much better. So our rating is only triple B minus because of a bias of those people. Those people meaning S&P, Moody's, and Fitch, and all those people. And what I am saying is not just for the sake of saying, it has been documented. It has been documented. One is the economic survey of February 21, and recently a paper in December 23 by the chief economic advisor, where they have laid bare what are our fundamentals, our debt level. Like the advanced countries have much higher debt levels, but they have like AAA or AA rating, and they have per capita income as one of the parameters. How does it matter? It is about India's ability or lack of ability to pay back our debt. How does per capita matter? And there is weightage in that rating of what they call think tanks. So think tank basically means people abroad, economists who have a certain opinion about India. So net what it means, our sovereign rating is only triple B minus. Now coming to your point, even before I give the answer, let me tell you what is the extent of exposure of FDIs or FIIs into our market. In equity, they own 17 to 18% of market cap. In bonds, in G-Sets, they earlier owned less than 2% of outstanding bonds. Now after the inclusion, they own like approximately 2.5% of outstanding bonds. So what is the linkage? They perceive India as triple B minus. Now no FPI will say this in so many words, but that is their perception. So what is the relevance? Now that JP Morgan, they have included us in their emerging market global bond index. Now the perception is changing. So two things here. One is passive funds. So passive funds will simply follow. So in the JP Morgan index, they have 23 what is called FAR. FAR stands for fully accessible route. So there are approximately 30 government securities which are part of this FAR list, and JP Morgan has 23 FAR securities. So the passive FPIs, debt bond FPIs, they will simply mirror the index. And there are active funds also who are buying Indian bonds now, either FAR or non-FAR G-Secs, by the feel good factor. Because so far it was like, the agencies they know of, like S&P, Moody's, Fitch, they have rated us triple B minus only. So now that JP Morgan, which they know, they have included us, perception has improved. Bloomberg also has announced, JP Morgan announced in September last year, inclusion started now in June 24, 1% each month, culminating in 10% by March 25. Bloomberg will start in January. So now that JP Morgan and Bloomberg have included us, that perception is changing. So what is happening now, from the announcement of inclusion in September 23 till today, as per my numbers, approximately $12 billion has flown in. So estimates range from 20 to 40 billion dollars, depending like active fund, passive fund, and all that. So yes, approximately $2-3 billion per month would flow in, and it is flowing in because of inclusion in the index, passive funds, and also the feel good factor, which is relevant for actively managed FPIs, bond FPIs. So what are the positive impacts? One is inflow of money. So cost of government borrowing will be lower because so far the demand is there in India from banks, insurance companies, and others. Now there is one more channel from which demand is there. FPI is coming in with incremental money. Inflow of forex. We have seen our forex reserves being higher than earlier. Now one may say that they will buy only so much. They will not buy forever, but at least for 1 or 2 years we have a positive flow. And another concern voiced is that in case they exit. Okay, so theoretically yes, but my view is we offer a good deal. What is a good deal? Our 10-year G-Sec yield is around 6.9 or maybe 6.85%. How many countries in the world offer a comparable or higher yield? Now, there are countries like South Africa or Brazil who offer a higher yield, but the sovereign rating of South Africa and Brazil is lower than triple B minus. They are not investment grade, lower than India. Maybe only Indonesia is comparable. They are similar rating, their yield offered is little higher. And there are countries which offer a higher yield which are not comparable. Countries like Turkey, like Argentina, like Pakistan. Their fundamentals are not comparable with India. So net we offer a good deal. So also yield we are offering, and our currency is more stable than earlier. So even now rupee is weakening, but the pace of weakening is slower than earlier. So that our currency is less volatile now. So one concern which FPIs may have, that depreciation of the rupee, that concern is lower than earlier. So net yes, it is a positive, and FPI money is flowing into bonds, subsequent inclusion. Only FTSE has said no to us for the time being. There are 3 indices, JP Morgan, Bloomberg, and FTSE. FTSE is not doing it now. JP Morgan and Bloomberg, they have done the inclusion, so it's a positive for us.